Ranil Krosner, thank you very much for joining CNBCTV18. Well, first up, since you have had a stint at the Fed and I hear you've spoken a lot about it, what is your interpretation of Janet Yellen's recent statement that the rate hike could happen 6 months after quantitative easing ends? In your mind, looking at the data that's available in the U.S. economy, when does QE end and when do you think rate hikes might start?
Well, I think the market expectations were similar to what Chair Yellen had been saying, that the taper, that is the reducing the pace of increase of asset purchases. Remember, the Fed is still buying more assets. It's just reducing the pace of the increase. That will continue probably through roughly the beginning of the fourth quarter of this year. And so probably those asset purchases will wind down around then. And then sort of 6 months or so afterwards, you might begin to see an interest rate increase. So sometime in the middle of 2015 would be a reasonable time to expect the first interest rate increase to occur. Okay.
When that happens, do you think, or by then, the 10-year could go very sharply higher? It's now at what, 2.7 or thereabouts. Where might it be in the next 18 months or even less in the next 15 months?
Well, certainly the Fed is hoping that it's not going to move sharply higher, and that's why it's trying to talk about what it's going to do over the next year and a half now to have markets expect that, so there won't be any sharp movements. Certainly, it'll depend primarily on economic circumstances. Will we have a more robust recovery? The Fed is forecasting growth closer to 3% rather than the 2% that we've had for the last few years. And if the labor market starts to improve, we could start to see a little bit more inflation pressure. I don't think it's very likely, but all of those things will be signs of health of the U.S. economy. So there'll be more demand for borrowing, and so the 10-year rate would start to move up.
So what might be the trigger for the rate hike, you think? That there are incipient inflation fears, or that the economy is robust enough and therefore it merits to move away from zero? What might be the trigger?
So in some sense, the Fed is hoping that we'll get inflation will move closer to its goal of 2%, because right now it's running significantly below that. And in particular, we'll have that being driven by higher economic activity in the U.S. So I think the hope is that the U.S. economy will start to grow a little bit more robustly. We'll see a little bit more investment, more hiring, and so that will then lead the Fed to say, well, we have to start taking a little bit away now after spending 5 years of putting $4 trillion into the economy.
No, the reason why I'm asking you is that if the reason for the rate hike is the robustness of the U.S. economy, then asset markets, usually risk asset markets, equities, will take it pleasantly. The last time you were in the Fed was when the first rate hiking cycle, the previous rate hiking cycle, started and matured. The equity markets took it very well. How do you think it might play out this time? Will there be another shiver in the emerging markets like we saw in May last? Or do you think it will be more like 2003 and the markets will respond positively?
Well, the hope is everything will be smooth, but there are always going to be bumps along the way. There'll be unexpected things that will happen, whether it's the challenges now in Crimea, which certainly weren't anticipated. Undoubtedly, there'll be something else that will happen like that to cause some shivers in the markets. But I think because things have been reasonably well telescoped, that here's our plan for the next 18 months, there shouldn't be as many shivers. However, when last May, Chairman Bernanke said that in 6 to 9 months we might start to reduce the pace of increase, that certainly sent shivers to the markets. So I don't think the shivers will be the same. There could be some other sources of them, and undoubtedly there will be.
Okay. Well, the asset markets have got used to this liquidity. Let me just shift focus to the other asset markets. Are you seeing Europe likely to use QE in some fashion later this year, in the next 15 months, an LTRO or some other avatar of liquidity easing?
Well, certainly Europe is seeing very low inflation outcomes, and it appears to be declining inflation. And for anyone like myself or Chairman Bernanke or others who've studied the Great Depression, it's very scary to see the prospect of deflation. And even the Bundesbank recently has said that they might be open to the possibility of QE to try to defend against the deflation outcome. And so I think it's going to be important, if they do see these deflation trends continuing, that they need to react to that, to both change the amount of liquidity in the system, but most importantly, change expectations to make sure that they'll do whatever it takes to avoid deflation.
What about Abenomics, or what happens in Japan? Is that also another central bank that is likely to keep the liquidity tap on for all of 2014 and some part of 2015?
I think Governor Kuroda is very much committed to that, and I think Abe is committed to that. That's been the first arrow in the quiver, and I think it's hit its target, because it really has helped to change expectations of inflation and to get actual inflation to be positive rather than negative. 15, 20 years of sort of a slide in Japan, partially because of the deflation, has been really problematic. I think it's likely that this is going to continue for some time, because I see some headwinds in the Japanese economy going forward.
Well, I'll come to China in a bit, but the reason why I'm asking you about Japan and Europe liquidity trends is that would your assessment be that even as the US winds down, there are going to be other sources of liquidity in global asset markets?
I think certainly you're going to be seeing more liquidity coming in Japan, likely more liquidity coming in the ECB. And remember, the U.S. is just stopping the pace of increase. It's highly unlikely that the Fed is going to start selling off any parts of its portfolio. And it may start to raise rates sometime in mid-15, but that also could be postponed if inflation outcomes are very low, if we're not getting enough growth.
Fair enough. Okay, so I think any fear of too much of liquidity evaporation is too premature at this juncture.
I think that would be unlikely, but there may be some, like the UK may start to pull back, because they're starting to see some stronger growth. The US may pull back a bit, but I think it's unlikely to see big asset sales.
Okay. Well, one final word before we move to China on the US Federal Reserve's thinking. It's obvious that every country will run its monetary policy to its goals, for its own goals. But is there a certain sympathy about global markets? If they are too roiled, that would be a factor. For that matter, on September 16th itself, was the fact that the Fragile Five, or even the rest of the markets, were so roiled that that was one small factor, at least, in postponing QE, which was actually expected in September 2013.
So I think the very strong reaction in the markets generally, not just in emerging markets and not just in the U.S. markets, to, as I said, the chairman just saying that in 6 to 9 months it may be possible to slow the pace of increase, not reduce, and sell, but just slow the pace of increase, sent the U.S. Treasury markets moving very rapidly, and sent some chill throughout the world. So I think they've really tried to recalibrate the way they talk about these things. And so when the actual tapering began in December, there were very little disturbance in the markets. Most recently, when the FOMC statement came out and Janet Yellen's press conference made it clear that they're going to be continuing on this path and interest rate increases might come a little bit sooner, that hasn't had the same negative impact. The rupee has been continued to be recovering. The stock market has done quite well in the last week or two. So I think the markets are better prepared for this. But undoubtedly, there'll be a shiver that will come from something at some point. No, it's not going to be perfectly smooth sailing.
I just want to know if, global markets, emerging markets included, is a factor which the Fed keeps on its radar.
So it certainly is looking at the whole world, looks at developed countries and looks at emerging markets. And to the extent that that's affecting the U.S., that's definitely taken into account. But as you had mentioned, the mandate that comes from each country's legislature is to have a prime focus on the U.S. economy. But I think the thought also is that if we can get the U.S. economy moving a little bit faster, that can be helpful for many emerging markets because they tend to be very important trading partners with the U.S.
Up until September, India was roiled, but now it seems odd to even put it as a fragile currency. It has been a picture of strength. You think something has gone right over here?
Well, the current account deficits that people have been very concerned about seem to have stabilized. So they had been seen as widening, and now that they're more stable, I think also people have a great deal of confidence in Governor Rajan, my good friend and co-author. So I know that is very well placed, and I think he has taken steps to make sure to respond to the inflation pressures that are out there, and I think that's been very important.
Time permitting, I'll come back to that topic, but more on China. How do you read, first of all, the country's slowdown? Are you going to see a fairly severe slowdown? People are still talking in terms of, 7.3 to 7.5, which is not all that slow, but can it get much worse?
So obviously the Chinese government is very much committed to trying to keep growth around 7% or so. That's their goal. And of course, in the past, when the Chinese economy has faced challenges, they have been able to use different levers on monetary policy and fiscal policy and restructuring of banks to try to respond to that. And I think they're very much committed to that. The question is, are the problems so large that it's going to be difficult for them to deal with that? I think in the short run they'll be able to deal with it, but it really depends on the extent of the challenges in the housing market and to some extent the shadow banking sector. And I think we don't have enough data to be able to say whether the problem is extremely large and too difficult to deal with, or one that they can deal with at least in the short run.
Well, you've studied a little bit of Chinese debt. I read your comments on the lack of a middle class in China because of lack of retail credit. But first, the wholesale credit itself, can it get messy? We've seen 2 bond defaults, but that's a minuscule amount. Can it go a little out of control of policy?
Well, obviously the Chinese are hoping not, and that's why they've allowed for 1 or 2 of the defaults to take place, which I think is healthy. Any robust economy is going to have some winners and some losers, and people have to get used to dealing with that. The question really is, what is the size of this? There's a lot of corporate debt outstanding, and there's a lot of municipal debt outstanding. And so there are definitely fragilities there. And so the Chinese officials have to make sure that the underlying fundamentals are generating enough income that they'll be able to make the payments on these. But it is a fragile situation. So
if you have to make a guess, can growth go down in a couple of quarters or for a couple of quarters to sub 6 or sub 5? That kind of a danger is not ruled out?
Well, certainly, given that my time in Washington during the financial crisis, I never say never about anything. So anything is certainly within the realm of possibility. But the odds. But it could be that you would see some slowdown for a few quarters as they're doing the restructuring. If there's more of a problem in the housing and property market, that's going to take some time to deal with. I think in principle they've been able to deal with these kinds of things in the past, but it really depends on the scope. And the larger the scope, the more likely it is that there'll be pressure on GDP for a number of quarters.
What about the recent devaluation? Would that be a strategy that they will adopt as a stimulus?
Well, I think it's one that they've thought about. Well, what's the right way for the renminbi to move, and maybe allow a little bit more market forces to come in, because ultimately they say that they want to have the renminbi be determined by market factors, and so that's another policy lever that they haven't used in the past.
Net, you have a number on their GDP growth for FY14 and for calendar 14 and 15.
So I think the crystal ball is quite cloudy. I think there are basically 2 kinds of outcomes. One is going to be sort of the good outcome in the 7s, and the other is an outcome that might be more like in the 5s. I put the probability higher on the 7s, but I don't want to, as I said before, I never say never about the 5s. Okay,
even in 2014, or you're referring to 2015?
15.
Okay. Well, now just a last word to end with your colleague and your co-author, Governor Rajan. What really is your comment on the way he spoke up for emerging markets? Do you think that is correct, that global banks, central banks, should have to be conscious of the global impact of their actions?
Well, I think that they are, but as I said, most central banks, I think all central banks, have mandates from their legislature, from their executive, to have a primary focus on their domestic economy. And I think in the way the U.S. Fed thinks about it is they focus primarily on the U.S., but also in thinking about emerging markets. If we can get the U.S. growing more strongly, since emerging markets tend to be very important trading partners of the U.S., that will also help their economies. So certainly no central banker wants to cause disruptions in any part of the world. But typically the primary focus is on getting the domestic economy going. And I think for an economy like the U.S., that can have very positive effects on countries like India and other emerging markets.
Right. Well, since you are a former central banker and continue to write and think on that space, and you're a colleague of Governor Rajan, how would you rate him as a finance expert and as a central bank governor? You have a 200-day record.
Well, it's a 200-day record, so I think it's a little bit early to give a final grade in a class on that. But Raghu is a superb person, incredibly knowledgeable, incredibly thoughtful, obviously one who had seen many of the fragilities that were coming and came to fruition, unfortunately, in the financial crisis. And so I think right out of the box, he focused on trying to introduce more competition in the financial sector here, introduce more inclusion, which I think is extremely important to get people into the financial system, because that's really where a lot of growth and domestic consumption will come from. So I think that's very valuable. And I think he's also been very good on making sure to bring short rates up to try to fight inflation expectations and the inflation situation that he inherited. And so I think that portends well for the future.
Well, it looks like you're giving him a 4 point on everything. Thank you very much. No, go ahead. You want to say
well, as I said, it's very early, but I think these are extremely good moves, both on the competition side and on the inflation side.
Right. Pleasure speaking with you, Professor Krajna, and thank you very much for joining us on CNBC.
Thank you so much.
That's it on Indianomics. Thanks for watching.